Hey everyone, Coach Investor here, back to another video for today. So, earnings season is here. First up, we have Netflix. At the time of making this video, stock is up 7% after hours. Of course, that can change whenever you're watching this video. Huge news with this report. Reed Hastings, the CEO, is stepping down. We will now have two co-CEOs. We're going to talk about all of that in this video. Revenue beat, earnings per share a miss, but there is a reason for that. They've added plenty of new users, so Netflix is far from being dead. Remember, not that long ago, actually, just a year ago, everybody was saying Netflix is dying, content is garbage, nobody wants to sign up anymore. Well, it's clearly not the case. So we're going to go over all of that in this video. If you enjoy this type of videos and want to see more earnings reviews, maybe hit that subscribe button and that thumbs up button as well, as it really helps the channel out. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So first things first, here we're going to look at this chart right here. So revenue came in at $7.85 billion. They forecasted $7.77 billion. So they beat on that. Operating income reached $550 million. They forecasted for $330 million. So operating margin is now 7%, which is higher than what they forecasted before. Obviously still far away from what it was a couple of quarters ago, but year over year, we're reaching those levels again. Net income of just $55 million, and then diluted earnings per share of 12 cents. They expected it to be 36 cents, but there is a reason for that. We're going to talk about that a bit later in this video. Continuing here now, they reached 230.75 million global streaming paid members, 4% growth year over year, and that means that they added 7.66 million members. They forecasted to add 4.5 million, so quite a nice beat here. When it comes to free cash flow, $333 million here. It's been a couple of quarters actually of being free cash flow positive. So that's great. That's probably a big positive. That's maybe why the stock is also reacting so positively to this report, because of, well, the free cash flow projections for 2023. And here it is, basically the announcement that Reed Hastings is stepping down and will become executive chairman, and Greg Peters and Ted Sarandos will be co-CEOs. And this means that Bella, formerly head of Global TV, has become chief content officer, and Scott has become chairman of Netflix Film. So little changes here, succession moves that make a little bit more sense than those at Disney. Now, with regards to the miss in earnings per share, so they say here that EPS in Q4 was 12 cents versus $1.33 in the same quarter last year. This was below their forecast of 36 cents due to a $462 million non-cash unrealized loss from the FX remeasurement on their euro-denominated debt as a result of the depreciation of the US dollar versus the euros during Q4 2022. They continue by saying here, as a reminder, our approximately $5 billion of euro bonds provides us with some natural hedge on the relative value of the euro for net income. However, it doesn't affect operating income, as unrealized gains or losses are recognized below operating income in interest and other income. For the full year, we recognize a non-cash unrealized gain of $353 million from the FX remeasurement on our euro bonds. Now, they do say here that operating margin reached, on an adjusted basis, reached 20% for the full year of 2022. So that's at the high end of the 19 to 20% target that they set in January 2022. Of course, always nice to see that. It is an adjusted basis, but hey, we'll go with that. Now, with regards to forecast for Q1 2023, we're going back to the top of the report here. So revenue, they expect it to grow 3.9% year over year to $8.17 billion. Operating income, huge boost here quarter over quarter, $1.62 billion, which means operating margins is back at that close to 20%, more specifically 19.9%. Net income, $1.27 billion, and then diluted earnings per share of $2.82. They are not really giving us here any numbers with regards to the net additions here, so let's continue and scroll through this report. Now, in the forecast section here, they do talk a little bit about Q1 when it comes to paid net adds. So they expect a modest positive paid net adds in Q1 versus negative ones same quarter last year. Now, their expectations of fewer paid net adds in Q1 2023 versus Q4 is consistent with normal seasonality and factors in strong member growth in Q4, which likely pulled forward some growth for Q1 2023. Now, they are talking here, of course, about the paid sharing and that rollout and how that will impact the business. Of course, in the short term, that might impact and probably will be impacting the business more negatively when it comes to engagement. Overall, it should be a positive impact on the balance sheet because, well, if you want to use your account, you will have to pay for it. So that's obviously a positive for Netflix. But some users might just decide to not watch it anymore, maybe through illegal streams, who knows. But short term, they do expect to take a hit on engagement. So when we see some graphs from, I don't know, Nielsen or whatnot and see engagement drop, that might be one of the reasons. And now when it comes to content and marketing, and this is what I said in my Disney video as well, Netflix is not dead. There are a lot of good shows on Netflix, and this actually proves it, all right? Last year alone, they launched 5 of their top 10 most popular English language TV seasons ever, 4 of the top 10 most popular English languages films ever, 7 of the top most popular non-English films ever on the platform, 2 of the top most popular non-English TV shows ever as well. Remember, Wednesday, Stranger Things, Ozark, Squid Game, all of those things are on Netflix. They are extremely popular. Now, of course, we have to talk about competition, not just the other streaming platforms, but they do talk here about linear TV, YouTube, short-form entertainment like TikTok, and gaming, to name just a few. Now, they say here the silver lining is that the market for entertainment is huge, and Netflix is still very small by comparison. For example, in the more than 190 countries we operate in, our over $30 billion of annual revenue compares against the combined annual estimates of around $300 billion pay TV streaming industry, $180 billion branded TV advertising spend, and $130 billion consumer spend on gaming. So still a long way to go. And not just that, if we continue to scroll down here, we can clearly see that in markets such as Mexico, Brazil, Poland, they are less than 5% of TV viewing. In the largest markets like US and UK, they are still less than 10% of TV screen times. They believe that eventually everything will be streamed. I believe this as well. Then of course this percentage here should increase accordingly. Now when it comes to free cash flow for the quarter, we've talked about that, but now, assuming no material swings in FX, they expect at least $3 billion of free cash flow for full year 2023. Now, they've reached this point where I do believe that free cash flow will continue to grow as the majority of the big investment in infrastructure, in building IP, etc. has been done in the past decade. They believe it as well. So now I do believe we'll reach that inflection point where from a free cash flow standpoint, I do think that we're going up from here. Now, of course, I can't end this video without talking a little bit on the launch of the lower priced ad-supported plan. So they launched it in November in 12 countries. They believe branded television advertising is a substantial long-term incremental revenue and profit opportunity for Netflix, and their ability to stand up this business in 6 months underscore their commitment both to give members more choice and to reaccelerate their growth. They're still in the early days for ads and they have lots to do, in particular better targeting and measurements. Again, they're working with Microsoft in case you forgot. We are pleased with our progress to date across dimensions, member experience, value to advertisers, and incremental contribution to our business. They continue by saying here, and this is very important, engagement, which is consistent with members on comparable ad-free plans, is better than what we had expected, and we believe the lower price point is driving the incremental membership growth. Also, as expected, we've seen very little switching from other plans, which means that people that are paying, I don't know, $12, $13, $14 or so are still paying for those memberships and are not going and paying, I don't know how much that was the ad-supported tier, but they are staying with the premium one. Well, pretty good for them. Of course, now with the password sharing stuff, maybe some people will just choose to go on the ad-supported way. They do end by saying here that it will generate incremental revenue and profit, though the impact on 2023 will be modest, given that this will build slowly over time. Makes sense. So to conclude, to me, another great quarter for Netflix. Great execution. Of course, now we're entering a new chapter with Reed Hastings stepping down. So pretty exciting new chapter as well, because they're now going into the advertising route as well. Password sharing, let's see what happens with that. But again, pretty exciting moving forward for Netflix. The story is not done here, not even close. Of course, do share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.